$2.8 billion. But that is what America pays in debt interest daily. Every single day in 2026, that bill comes due before Washington funds anything else at all. That number is not an abstraction sitting in some government report nobody ever reads carefully. It shows up in your mortgage rate, your car loan, and your credit card bill. And here is the part that changes everything about how you understand this story today. The countries that used to finance America's debt are quietly and methodically walking away now. Subscribe to the Economic Code right now because this story gets more serious by the minute. To understand why this matters so deeply, you have to go back to how this started. For decades, the United States ran what economists called an extraordinary privilege, unlike anything in history. America could borrow unlimited money from the world at incredibly cheap interest rates, almost at will. The dollar was the global reserve currency, and Treasury bonds were the world's safest parking spot. Every central bank, every sovereign wealth fund, every foreign government wanted a piece of American debt. Japan held over $1.2 trillion in U.S. treasuries as recently as late 2025. China held hundreds of billions more, and Europe collectively controlled trillions in American government bonds. That arrangement gave Washington a superpower. No military could ever provide on any battlefield anywhere. It could spend beyond its means indefinitely because the world kept voluntarily funding the difference. But something started shifting around 2021. Slowly at first, then faster, and now unmistakably. In 2026, China began quietly reducing its treasury holdings, selling off hundreds of billions across several years. By late 2025, China's U.S. Treasury position had fallen to $682 billion. That was a 17-year low, the lowest level of Chinese treasury ownership since the year 2008. Since 2021 alone, China has reduced its American debt holdings by more than $250 billion. $250 billion gone, quietly sold off while most financial headlines focused on tariffs and trade wars. Meanwhile, Japan's investors, historically the most aggressive foreign buyers of U.S. treasuries on earth, began reconsidering too. Japanese bond yields started rising at home for the first time in decades, changing the math entirely. In January 2026, Japan's 40-year government bond yield hit a record high overnight without major warning. When Japanese yields rise at home, there is less reason to send money to America instead. Ed Yardani, one of Wall Street's most respected market strategists, explained this dynamic with unusual directness. He said, Japanese investors who had been particularly aggressive buying U.S. debt may now just stay home. That phrase, stay home, sounds simple, but it carries enormous consequences for American borrowing costs going forward. India followed a similar path with Treasury holdings dropping to around $90 billion. By the end of October 2025, India had quietly reduced its exposure to American government debt significantly. Denmark sold Treasury bonds too, though U.S. Treasury Secretary Scott Bessent publicly dismissed Denmark as irrelevant entirely. He said Denmark's holdings were less than $100 million, and he was not concerned. But here's the problem with that dismissal and why it actually reveals something critical right now. Denmark is not the story. Denmark is a symptom. The story is the direction of the trend. Now, when multiple countries across Asia, Europe, and the developing world all move in the same direction simultaneously, when the world's second largest economy is at a 17-year low in American debt ownership, when the world's largest foreign holder of U.S. treasuries is reconsidering its commitment to sending money over, that is not noise in the data. That is a structural shift in the global financial order. And the Treasury auction data from 2026 makes that structural shift impossible to honestly ignore or dismiss. In March 2026, the U.S. Treasury held 3 major debt auctions within the span of 1 week. They auctioned $69 billion in 2-year notes, $70 billion 5-year, and $44 billion 7-year notes. That is $183 billion in new debt sold in a single week alone. All 3 auctions went poorly, every single one by every standard metric used to measure auction health. The bid-to-cover ratio, which measures total demand relative to the amount on offer, came in below average. Primary dealer absorption was elevated, meaning the banks of last resort had to absorb more than usual. The auction tail, which measures how far the clearing yield deviated from expectations, widened on all 3. The Committee for a Responsible Federal Budget analyzed those results and called them a warning sign. They noted that long-term interest rates were already 30 basis points above CBO projections for 2026. 30 basis points above projections sounds technical, but its real-world consequence is massive and immediately personal. The CRFB estimated that GAAP holding for a decade would add $1 trillion to interest costs. And then, in May 2026, a $16 billion auction of 20-year Treasury bonds revealed even sharper investor anxiety. Overall demand came in at 2.46 times the amount offered, the weakest since February. The auction cleared at a high yield of 5.047% above pre-auction levels. Immediately after results, the yield on 20-year Treasuries jumped to 5.127%. That was the highest level for that particular maturity since November of 2023, a meaningful multi-year marker. George Cipollone, portfolio manager at Penn Mutual Asset Management, put it plainly after that weak auction. He said 5% yields with another weak auction is not a sign of confidence. Tom Dialoma at Michelle Financial said the market is simply fighting with the government right now. He said there's too much debt out there and the market is figuring things out. These are not fringe voices. These are mainstream institutional money managers saying something serious is happening. The auction data reveals not panic, but something structurally far more concerning than panic alone. It reveals a buyer base slowly and quietly demanding higher compensation just to keep showing up. And every time they demand higher compensation, the interest bill on $38 trillion grows even larger. And that growing interest bill is where this stops being abstract and starts being personal. In 2020, America paid $345 billion annually in interest on its debt. In 2025, that number hit $970 billion, nearly tripling in just 5 years. In 2026, CBO projects that figure crosses $1 trillion for the very first time in history. $1 trillion in annual interest. That is $2.88 billion every single day. More than America spends on national defense, more than Medicare, more than any other single budget category. And the CBO does not project this slowing down after 2026 under any realistic scenario going forward. By 2036, annual interest costs are projected to more than double again, reaching $2.1 trillion. Over the next decade alone, cumulative interest payments total $16.2 trillion in official projections. That is 3 times what America spent on interest across the entire prior 20 years combined. That is $47,000 per living American citizen just in interest over the next 10 years. These numbers come directly from the CBO's official long-term budget projections released in early 2020. Sussex. Now here's the central question. Nobody in Washington is answering with any real honesty right now. If foreign buyers are pulling back and domestic demand alone cannot absorb this volume, who actually buys? When foreign demand weakens, the U.S. Treasury must attract domestic private buyers to absorb the shortfall. Pension funds, insurance companies, money market funds, mutual funds, and American retail investors step into that gap. But those buyers are not charities. They respond to price signals, and the price signal is yield. To attract more domestic buyers, the Treasury must offer higher yields on every bond it sells. Higher Treasury yields mean higher borrowing costs, rippling outward into every corner of the American economy immediately. Treasury yields are the benchmark rate from which virtually every other American interest rate is calculated. Your 30-year fixed mortgage is priced directly off the 10-year Treasury yield, without exception every time. Car loans, small business loans, and corporate bond markets all move in lockstep with Treasury yields. When Treasury yields rise because foreign demand falls, the cost of borrowing rises for every American simultaneously. The CRFB ran this exact calculation in May 2026 and published their findings in detailed budget analysis. They found Treasury yields were already 55 basis points above CBO projections at that specific moment. A 55 basis point rise on a $500,000 mortgage adds $200 monthly. Over that mortgage's lifetime, the same rate difference adds $64,000 in total additional cost. On a $1 million mortgage, the same shift adds $130,000 lifetime entirely. This is the direct measurable consequence of the dynamic playing out right now in Treasury markets. Every basis point the world demands above expectations comes directly out of American household budgets permanently. Now, here is what makes this structurally different from every previous debt concern in modern financial history. When Treasury demand weakened in the past, the Federal Reserve stepped in as buyer of last resort. During the 2020 pandemic, the Fed bought nearly all of the $1 trillion in new treasuries issued. Private investors, net of Fed purchases, bought essentially zero additional treasury bonds during all of 2021. The Fed created money, purchased treasuries, and kept yields artificially suppressed to prevent economic collapse. Then that tool worked, but using it aggressively creates a severe consequence, which is inflation punishing everyone. The inflation surge peaking at 9.1% in 2022 was partly a direct result. It wiped out real wages for millions and forced the most aggressive rate hiking cycle in decades. The Fed raised rates from near zero to over 5% in 18 months, a historic cycle. Those higher rates are now exactly why Treasury interest costs tripled since 2020 in the first place. So the Fed cannot easily rescue the Treasury market again without risking a repeat inflation episode. It is trapped between two bad outcomes with no clean third option available on the immediate horizon. If it buys treasuries aggressively to suppress yields, inflation returns and purchasing power erodes again severely. If it stays out, yields rise, borrowing costs climb, and the fiscal cost spiral accelerates further. Still, this is the bind that structural foreign retreat from U.S. treasuries has helped create over several years. The weighted average rate America pays on its entire outstanding debt keeps rising every month. Still, by April 2026, the weighted average rate on Treasury debt reached 3.34%. In 2021, that same weighted average was approximately 1.5%, less than half of today. As older, low-rate bonds from 2020 and 2021 mature, they must be refinanced at today's market rates. The government is rolling over trillions of cheap old debt into expensive new debt every single month. The Peter G. Peterson Foundation tracks this daily, and their data confirms the trajectory in real time. In fiscal year 2026, America is on track to pay approximately $1.05 trillion in interest. That works out to $33,000 per second of every day this entire year. Now zoom out and see the macro picture this creates for the global financial system overall. For decades, the unspoken deal underpinning global finance was that American debt was the universal risk-free rate. Every financial model, every pension fund, every insurance company used Treasury yields as their baseline anchor point. If that anchor drags, if yields become unpredictable and foreign retreat makes auctions unreliable, everything reprices. Global equity markets price risk relative to the risk-free rate of U.S. Treasuries at every moment. Corporate bonds are priced above Treasuries. Emerging market debt is priced, it spreads above that baseline. When the baseline shifts, the entire global financial architecture must reprice simultaneously with painful volatility everywhere. This is not theoretical. In April 2025, tariff announcements caused stocks and Treasury yields to rise together. That unusual correlation alarmed analysts, suggesting Treasuries were no longer functioning as a pure safe haven. Normally, in a crisis, investors sell stocks and buy treasuries, pushing yields down as money floods in. State Street Global Advisors documented this shift, noting fiscal concern had raised the term premium measurably. A higher term premium means investors demand more compensation for the uncertainty of holding long-duration American debt. That is an extraordinarily significant signal from one of the world's largest institutional asset management firms. And that signal from State Street is not sitting in isolation inside some obscure research note. It connects to a broader, measurable loss of confidence in America's ability to manage its finances. For decades, investors accepted lower yields on treasuries in exchange for certainty of getting repaid. The safety premium in American debt was so strong that investors essentially paid Washington for the privilege. Negative real yields were accepted because the alternative felt riskier than quietly losing purchasing power. That trade is now being unwound. The safety discount on American debt is being removed by markets. And once that psychological anchor shifts, the feedback loop becomes extremely difficult to reverse or contain. Higher yields attract some buyers, but simultaneously increase the deficit, requiring more borrowing at those yields. More borrowing pushes yields higher still, demanding even greater compensation from the remaining buyer pool. This is the fiscal spiral economists warned about for years now, visibly beginning in 2026. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, has been publicly direct about this. He has repeatedly warned that America faces a debt crisis unlike anything in the modern post-war era. He described the Treasury supply-demand mismatch as the single greatest risk facing global finance. Dalio argued America must either cut spending, raise taxes, print money, or face a genuine debt crisis. None of those four options are painless. Every single one transfers enormous costs to ordinary Americans directly. Cutting spending reduces services millions depend on, from healthcare to infrastructure to education and social support. Raising taxes reduces disposable income, slows consumption, and suppresses economic growth in the near and medium term. Printing money inflates away savings, punishes retirees on fixed incomes, and raises prices for every consumer immediately. A genuine bond market crisis raises rates so sharply that mortgages, businesses, and municipalities face funding emergencies. America is not passively watching this unfold. Washington has tools available, and some are already being deployed. The most important tool is domestic institutional demand management, actively encouraging American buyers to absorb the shortfall. The Treasury manages its issuance calendar with increasing sophistication to avoid flooding any maturity. By concentrating more issuance at shorter maturities, Treasury reduces direct pressure on longer-dated bonds significantly. But tactical management has real limits when the structural supply-demand imbalance is this large and persistent. The math in 2026 is genuinely staggering when confronted directly without any political filter. America needs to refinance approximately $9 trillion in maturing Treasury debt during calendar year 2026 alone. $9 trillion in 1 year. Not new borrowing on top of the deficit, pure rollover alone. All the debt issued at low rates in 2020, 2021, and 2022 is now coming due simultaneously. Every dollar must be refinanced at today's rates, roughly double what they were 4 years ago. That refinancing wave is the primary mechanical driver of the relentlessly rising interest bill today. It will keep driving costs higher for several more years until all cheap pandemic-era debt matures. He argued that controlling the deficit is the single most urgent priority facing Treasury right now. But deficit reduction requires political consensus that has proven nearly impossible to achieve in the current environment. CBO projected in early 2026 that the deficit would remain above $1.8 trillion. That projection assumed current law holds, with no new major spending bills passing on top of it. More debt means more supply. More supply without demand growth means yields rise to clear the market. Rising yields increase the interest bill, expand the deficit, and generate even more supply of new debt. This is the debt deficit feedback loop economists warned about, and it is clearly in motion now. For investors holding long-duration bonds, rising yields mean potential mark-to-market losses on existing fixed income positions. The Silicon Valley Bank collapse of 2023 previewed what rapidly rising yields do to bond portfolios. When depositors withdrew funds, SVB was forced to realize those losses, triggering a bank run and collapse. That dynamic is not unique to SVB. Any institution with long-duration asset exposure faces this risk. For homeowners, the Treasury yield to mortgage rate connection is the most direct personal transmission channel. For workers, the trillion-dollar interest bill squeezes funding available for every other government service and program. CBO projects interest will exceed Medicare by 2027 and exceed total defense spending entirely by 2038. By 2048, America will spend more on servicing past debt than investing in any productive future priority. That projection deserves to stop every American cold, regardless of political affiliation or economic philosophy entirely. The question is whether Washington can find political will to stabilize this trajectory before markets force it. History shows bond markets are more patient than expected, right up until suddenly they are not. Japan has managed debt to GDP exceeding 200%. But Japan is a net creditor nation by nature. America is a net debtor running persistent currency current account deficits and depending on continuous foreign capital flows. That structural difference makes foreign treasury retreat far more consequential for America than it is for Japan. The world is not dumping US debt overnight. There's no sudden dramatic crisis unfolding yet. What is happening is quieter, slower, and in some ways far more dangerous than sudden panic. It is a deliberate reallocation away from American debt by sovereign holders with decade-long investment horizons. Each percentage point shifting from foreign to domestic buyers at higher yields compounds interest cost permanently. The $2.88 billion per day America pays in interest today is not the peak. Based on every credible official projection, it is just the beginning of a much steeper climb. Subscribe to the Economic Code and drop a comment below telling us what you think right now. Do you believe America can stabilize this trajectory, or has this spiral already gone too far? Hit that like button and share this with someone who needs to understand what is really happening. This is not a political story. It is a mathematical one, and mathematics never negotiates with anyone.